Welcome to Petros Family Tax YouTube channel. Today we're going to talk about tax advantageous ways to give to charity. Petros Family Tax, Petros is Greek for stone or rock, and that's why Jesus renamed his disciple Simon, renamed him Peter Petros. Upon this rock I'll build my church. Jesus also said, give to Caesar what is owed to Caesar. And so today we're going to figure out how can we owe Caesar a little bit less so we have a little bit more for God's kingdom. So what I'm going to show you today is one of the tools that we use to identify some tax planning opportunities for our clients in order so they can keep some more of the wealth that they have and share more with others. And so whenever we work with a client that's charitably inclined, whatever dollar amount they feel called to give, we want to amplify that gift for themselves and their families and for the charities. So let me orient you a little bit to the baseline, and we'll cover a couple different concepts today. But let's use this scenario too, just kind of as a regular baseline. And then I'm going to cover what's called the lumping and clumping strategy. And then the other strategies I'm going to cover is what's called a qualified charitable gift, or qualified charitable distribution, and a gift of highly appreciated stock. So we're going to cover from left to right, and then we're going to go back over to the left. So let me just kind of give you the baseline case. Just kind of figure out, show you what's going on. So for this made-up person, we have $50,000 coming out for their IRAs, $80,000. These are professors I just made up there. $80,000 in between the two pensions, and Social Security about $70,000. What they also have is a capital gain. So they purchased and sold stock that they held for over a year and have a $15,000 gain. And then they have a number of deductions, state and local taxes. But the one I want to point out is they give around $20,000 a year to different charities. In this case, just on the federal side, I didn't have any state, just because each state is a little bit different. But they'll owe around $27,000. One of the strategies, or one of the things that occurred after the 2017 Tax and Jobs Act, is that our standard deduction doubled. What that means is that anytime we give to charities, if it's still whatever amount we give plus all the other deductions is still underneath the standard deduction, it's still better for you to take that standard deduction versus itemize and list all those deductions there. If we're underneath that standard deduction, any dollar we give, technically we don't get a tax benefit for it. So it's not as advantageous for you on the tax side, just because we're not actually getting any deductions for it. One of the first tricks is, if you don't want to change much, but you want to start to get some sort of benefit, one of the ideas is called the lumping and clumping strategy. So let's say, for example, a client continuously gives $20,000 a year. Instead of doing a whole lot of other changes that I'll show you in a second here that might be very fruitful, one of the strategies is just to lump and clump all of your charitable gifts into 1 year. So if you give $20,000 a year, if we skipped 1 year and then we gave $40,000, what that does is that clumps all those deductions in that one tax year. Same dollar amount over the course of 2 years, but the impact is that you finally can start to get some deductions. If you lump them, you actually get $4,000 of your money back by lumping it into 1 year. And then if you didn't do any charitable giving the following year, you can see it's pretty much the same tax dollar amount the following year, because remember, you didn't get any deductions for it for that $20,000 anyway if you did $20,000 a year. So if you lump and clump and then skip a year, and then lump and clump, skip a year, what that'll do is allow you to actually start getting some tax deductions because you're over that standard deduction limit. So that's one of the simpler tricks out there. Now the two other tricks I wanted to share, this is for folks that are over 70 and a half, and you have a traditional IRA, is typically not a whole lot of 401ks or 403bs can do this, but it's called a qualified charitable distribution. So you can give directly from your IRA, your traditional IRA, to charities, and if you're over 70 and a half, you do not need to take out those mandatory distributions. Depending on your age, it usually starts around 73, sometimes 75, where you have to take money out of your IRA. And so if you are in that RMD age, that qualified charitable gift, that'll count towards that mandatory distribution, but it'll never show up on your taxes. It actually reduces your taxable income by $10,000. And then the second trick we're doing is instead of selling that stock and then giving that money to charities, what we do is we just gift that charity that stock. And what that does is you do not pay taxes on the sale of that stock, but you still get the same tax deduction for that gift. And so when the charity receives it, you have to work with them, make sure that they have a brokerage account available, work with your advisor to actually gift the shares. But if you don't sell it, you just gift it directly, that charity can sell it. They don't pay any taxes, they don't get any less, and you didn't have to pay the capital gains on that. And so just those two tricks with the $20,000 ends up saving around $3,700 compared to our base case scenario where you're just giving cash. So that's more money for you, more money for your family, more money for charities that you can keep rolling into. Same dollar amount in all these scenarios, just a better way to owe less to Caesar there. Hope you enjoyed, and if you did, please go ahead and like, subscribe, and hit that notification button. Thank you much.